general market communication and information purposes and does not constitute independent investment research. Nothing contains or should be considered investment advice or an investment recommendation or indeed a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in Forex and CFD products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made on the information provided in this communication. This communication was not be reproduced or further distributed without our prior written permission. Okay, admin out of the way. That's me. Most of you in here have heard me before, seen my ugly mug before. So keep probability on your side. Keep it simple. Look at multiple time frames. But most importantly of all, know yourself. If you haven't watched my Mind Games webinar, I strongly recommend that you do, and that's where Bruce's question came from at the beginning of the session. So keep it simple, don't overcomplicate things. If it seems right, do it. If it doesn't, don't. But write everything down. But most importantly, know yourself. Trade around your psychology, around your personality. This business is 90% psychology, not trends, not fundamentals, not technical analysis. It's all about you and what's between your ears. Okay, so let's kick off straight into it. Dollar index is the weekly chart going back to June 2014. Last year it appeared to have a really strong, here we are, November, strong. We run up through 100. 2017 was a weak year for the dollar, contrary to what we thought at the beginning of 2017, and I was one of those guys. I thought it was going to be a strong buy the dollar year. It came to pass that we went all the way down here to 90, and we've broken even lower this key support level in the last few weeks as well. So a weak dollar continues. We've had a bit of a rally over our pivot point here, but we're down. We're under the blue line on all the charts. It's my favorite moving average, the 20 period moving average, and we've been under that for most of 2017. In fact, we were only over that for 1, 2, 3, 4, 5, 6, 7, 8, a couple of months during 2017. So a weak US dollar continues. Okay, and that is my outlook for the year. Here I've got the RSI on the weekly chart. Here in the monthly chart I have the RSI set at 7 because it's a bit more, as it's a longer term. I've reduced the RSI, and although it's looking oversold down here at this support level 91 at the moment, it's still looking weak, and the trend, as you can see, is clearly down. We've broken these support lines here, which became the pivot for the monthly pivot. These are these support and resistance lines here. P for pivot, R1, 2 and 3, S1, 2 and 3. These are the support and resistance lines based on the monthly chart. So you can see here we're broke down there, or at this monthly support level down here, and we will last down here multi-year lows. This is why this chart goes all the way back down here in 2014. Now the significance of the fact that we're down at 3-year lows for the dollar index is that, as you can see, when the dollar was well bid during the hiatus of 2013, 2014, it rallied and rallied and rallied and got much stronger. It hit the 100 and then came down and had another rally before the new president came in. So as this has rallied up quite nicely, markets tend to inverse the same. So we may, I'm not saying this is going to happen, but as we came down, as we went up very nicely and steadily, the dollar may continue its decline nicely and steadily, as we saw it did for most of 2017 there. Okay, so just excuse me a minute. Dollar weakness is the way ahead. So technically it's bearish. So the index is trading up to 3-year, multi-year lows, the pivot at 92.3, support at those 3 levels there, resistance down here at 97.33, and there's a lower, I thought I'd put a lower resistance on, oh sorry, it's the wrong way around, is it 94, 96, it's that way around, 94. But you can see here, there's also lower resistance, is here 88.50, those numbers are wrong, aren't they? Have I got that the wrong way, have I read that the wrong way around? Yes, sorry, I've the wrong way around. Support and resistance the wrong way around. So support down here, 88.50 is the key one. So right down here, and if we do get down here, this is the next support here. Again, this needs to hold, although we'll end up drifting down below that as well. So it's a distinct possibility as we go. But this time last year, I was saying the exact opposite, and I was wrong. So there you go. Charts are saying negative. We may turn around, but certainly it looks fairly negative. And that's really certainly the review issue, or the issues surrounding the dollar, is that the president has got through his big key tax bill. He needs to go and really sell that to the rest of the American public, his non-supporters, because these midterm elections that are due in November, right at the end of the year, halfway through his presidency, 2 years in, would suggest that they lose control of the Senate and the House, and the Democrats come back. So it makes him, he needs to be a bit more flexible, as I've put here, flexible at home, but why becoming more isolated internationally? That's my view of what may pan out during 2018. So the impact of that are countries like, he's already mentioned it in his foreign policy, countries like Pakistan, the area of Palestine, Iran, come more in the focus. Obviously, in the background all the time is North Korea, and then the other big political issue that won't go away is the hangover from pre-election. These investigations by special agent, I keep calling him special agent, Special Counsel Mueller into the influence that Russia had on the US election and indeed other elections around the world, but obviously Mueller's concentrating on what went on in the USA, and that won't go away, and it's getting closer and closer to the president's family and the president himself. So that will have a big impact on the US dollar if this doesn't go away, or it keeps on grinding on, which he has. Remember, there's 4 guys already arrested with regard to this investigation, so it's ongoing and one to watch in the background, as well as obviously the North Korean situation. The second key thing is the trade relations. So as the president and the administration becomes more perhaps flexible at home, it becomes more hawkish or bullish or centrist, back to USA first, as they keep saying all the time, and therefore things like a trade war with China is unlikely. A full-blown trade war is unlikely, but key resources like steel, aluminium, and the other key one is intellectual property rights. They're the 3 big issues between trade between the US and China. Remember, US and China, the 2 world's biggest economies, therefore the impact of these 2 guys rooking or falling out over trade becomes an issue for the rest of us. And the other key thing that's currently on the menu is obviously the North Atlantic Free Trade Association. That's the agreement between Canada, Mexico, and the United States about free trade between the 3 countries. That's very much in the spotlight at the moment, and he's talking about, and the president's even openly talked about pulling the US out of that rather than just renegotiate. So again, trade very much in focus. As far as the fiscal and the monetary, as far as the monetary policy is concerned, it's going to just be more of the same in 2017 than in 2018 than we had in 2017. The FOMC, in my view, will become more hawkish. Not necessarily as I've written as the year progresses, but I think they'll drift to be more hawkish as the vacancies become filled. Remember, we've got a new chairman, Jay Cowell. We've got a deputy or chairman that's not been appointed yet, but again, it's an appointee of the president. And the people that have become onto the committee that are now voters that weren't last year are more on the hawkish side than the people that have left the committee. So again, and the equity and bond markets still finished the year very positive and bullish, but perhaps not as much so as 2017. But so I expect a bit more volatility in those markets. It's very, very quiet volatile-wise from equities and bonds, but I expect a bit more volatility in 2018. So that's the key. That's my key thoughts, 3 key thoughts: political risk, trade, and the composition of the Fed and its policy. The markets are expecting 3 rate rises from the Fed this year: March, June or September, and December. They did 3 last year. It could easily only be 2 if things don't pan out as they do. But certainly I'm more on the 2 rather than the 3 side of things. But really, that sort of things, say pricing. So dollar key, dollar index key reflection of how the dollar affects anybody else. So any other thoughts from anybody else? Any questions at the moment? Let's move on. Next one. is the euro. So obviously, as the dollars weakened during 2017, we had a strong euro on the back of two things. One was the dollar weakness, and the second was here, sort of in the middle of the year, the political risk that we talked about this time last year of the French, the Dutch, the German, and other elections within Europe really becoming a bit of a non-issue, and in fact, the election of Macron in France became quite a positive issue for the euro, and that was the catalyst that started the euro rally back in April and May. Here, this big week here was a big euro week as we got back over the out of the 110 range, and we shot up, and we're at multi-year highs again as we start the year. Up here at 120, 123 we had a go at, didn't we, earlier this week. So strong euro. Again, just like the dollar index has been under the 20 period moving average for most of the year, the euro dollar here over the 20 period moving average for most of the year. And again, 1, 2, 3, 4, 5, 6, 7 weeks. And they weren't really significantly under it, were they? So a strong euro dollar continues into 2018, and will remain very bullish on there, especially last week. That big move on Friday, which created this big candle here on the weekly candles, was quite significant. The fact it was the final, I think I said this yesterday, I've said this many times in the last couple of weeks, it was the final trading day of the first week of the year, which can be quite significant for the year ahead. Certainly something like the dollar index has a, if you look back at the which people like I do, you look back over history, and the first week of January can often be quite a good indicator of where certainly from a dollar index point of view finishes the year, whether it's bullish or bearish. There's quite a strong correlation between that first week. So anyway, euro strong first week of January, just to continue its rally. Obviously got a wee bit overbought. Even here on the 7 period RSI, it's over 70, and on the 14 it'll be up to close to 80. So a strong euro, technically bullish, pivot point around the mid 18s. Support now raised quite significantly up. Even the lowest support is down here at 112.24, and resistance mid 21s, 23.32, which we sort of in touching distance of really now. 126.38, and then the big psychological 130. Lots of players, lots of big players are talking about 130 as being very quite attainable for the euro this year. I think it may be a bit of a stretch. These are the risks from 2017 that never really came to very much, to be honest. I mean, the surprising one, to be honest, probably of them all, was the one that we thought was perhaps most nailed on, was the German one, where Mrs. Merkel lost her significant majority, only in the this last week we thought it was the agreement with the SDP and the CDU had been agreed, and it seems to have not been the case. The SDP yesterday said that but they haven't formalised it from their Berlin office, or the Berlin section of it. So Sunday is a key day, but Mrs. Merkel is, and I wouldn't ever bet against her, she's a very shrewd politician, very effective politician, but all politicians have a career end date, and so a lot of her critics are saying perhaps she's coming to the end of that, but she's very keen to move this forward. The key thing for you, as far as you was concerned, was the election of Macron in France. A non-political party 2 or 3 years ago, centrist, but more towards the right wing, business focused, trying to shake up the very entrenched French unions, very entrenched structures in France. Had a really strong honeymoon period that's come to an end quite aggressively, but he's talking not just in support of France but in support of the whole EU area, and a strong central tie here between the two key economies of the EU, Germany and France, will be fundamental to the EU moving forward, not just this year but for the years to come, but also in the relationship with the offshore bad boy, as they see them, the Brexit that the UK have voted for. So very, very key, the relationship between these two guys. And next week, just a local thing, is the big meeting in Davos here in sunny Switzerland, and Macron and even Merkel could potentially be there as well. Macron definitely is, and it looks like he's going to have a big world stage to outline his view of Europe and France, and very, very in conflict with the US president, which I think is the day after, I think, or the day before, I can't remember, but certainly not speaking together. And even if Mrs. Merkel gets this thing sorted out on Sunday, she's likely to be there. She hasn't been there for many years, Davos, so it could be quite a key pivot again at the beginning of the year in Davos, but key for Europe. Certainly these two key economies. The risk this year is the elections in Italy, although Italian elections, Italian politics are fraught with deals and coalitions and weak governments. The talk of Italy swinging to the right again, the Northern League and the separatist right wing there, it seems quite strong. They're leading in the opinion polls. The re-emergence of Berlusconi in his 70s, believe it or not, is becoming a force again. So the uncertainty that's still hanging around Germany hopefully will go away, or I expect to go away in a couple of weeks, but it may not. This grand coalition may break down. That will hamper the euro clearly. And then the other political risk in Europe is obviously the Catalonian situation. Again, a separatist idea. The Spanish government very much obviously against it, but it's the power of the people in Catalonia. Apparently, they've had another vote. They sort of won the election. The leader is in exile in Holland, not in Holland, in Belgium. But so it's a bit of an issue. It's not it's not that significant issue for the euro, but it's these issues in Germany and Catalonia. It just chips away at the unity of the EU, and that's what the main political thinkers are worrying about. Anything that chips away at that, it questions the integrity of the actual currency itself in the longer term, not necessarily in 2018. Obviously, the other key thing from the other side of the negotiations is Brexit. Phase 1's been agreed, and the EU did very well, hardly moved their position at all. Phase 2, much more complex, much more difficult. All about trade, but again, the EU, right up until earlier, just this week, very, very united front, and then there was a break with news out of Spain and was it the Belgian? I can't remember who it was. No, it was Holland, wasn't it? It was Dutch and the Spanish foreign ministers suggesting there may be a softer Brexit that more acceptable to them. So the pound rallied on the back of that. But the key thing for me is that this time is very, very short. It was always very short. March 2019 will be round and with us before we can, blink. There's an awful lot of stuff to get through. The UK has been part of Europe for 44 years. There's lots of complex legal and fundamental positions that need to be sorted out, not just about trade. Trade is the one that's taken the headline, and the Brits are saying they want a special deal. They don't want a Canadian deal. They don't want a Dutch deal, Norwegian deal. They want a special deal because we're a special partner. And obviously the EU is saying, well, you're leaving the club. You've instigated the divorce. These are the terms. Come to the table, and that's the issue again. Those negotiations haven't started yet. It's not going to happen till the end of January. Big issue both for the euro and the pound, this Brexit talk of mine. As far as the ECB is concerned, and monetarily, the expectation, again, one of the rallies in the euro we've had recently is this expectation of unwinding this massive QE bundling. There was even talk yesterday of it just suddenly stopping in September when the current plan is due to finish. Personally, again, I think it's much more of a tapering rather than a sudden switch off. And the chatter of an interest rate rise in 2018, I think, is far too hawkish for the very, very not dovish, but the very, very what's the word I'm looking for? Very, very circumspect Mr. Draghi. He doesn't rush into these things very quickly. And although the end of the year is still, 3 quarters away, 8, 9, 10 months away, I can't really see an interest rate rise in the EU during 2018. Certainly 2019, possibly, and even that's not certainly nailed. So certainly QE unwinding coming down. There's more chatter on that, more hawks on the ECB, but interest rate areas, no chance, not really. It's my own personal view. The yen's a bit more neutral, pulling on both sides. The dollar's performed best against the yen simply because the re-election of Mr. Abe in October has just basically reinforced his hand, and it's just more of the same. The Abenomics, more or less failed, but his re-election with simply on the back of a weak opposition was a bit opportunist, and so really fundamentally and structurally nothing's really going to change in Japan. Although they keep growing, they've had 6 quarters of growth now. It's still very, very sluggish. So here we're pivoting around the key 1274. We've had a big dive down to another key area we talked about a lot of last year, 1080 level, where we are actually today, aren't we? We're around that sort of level we were when we saw. But again, very neutral. We're pivoting around here. We spent most of 2017 pivoting around. Obviously, the dollar rallied as with all the other currencies before the election, then slipped. But as you can see, it hasn't slipped as much as it has against the euro and the pound. So we've been pivoting around the 20 period, so no clear direction. So again, neutral to negative really on dollar yen, and that's more to do with the dollar weakness than any yen strength, because I think the yen is generally quite weak as well. So we're pivoting around 12.75 and resist support down at 10.8 and 106.85. And then the key 105 below that, resistance at 14, 16, 18, and then 21 on the on this chart. But 21's off the top, and that's way beyond any expectations really. So really pivoting around where we are now, this one between these two areas here. Top at 114, which we couldn't really get over during 2017, and the support at this 109 level, really 108.85 is the key level. So we're sort of in this channel, very much an oscillator trend for those longer term yen traders out there. So again, yen in line with the Bank of Japan and Abenomics. Very difficult growth in Japan, and again it's to do with the fundamentals of the Japanese. A lot of it culture as well. I haven't written that down there, but it's really Japanese culture, the demographics, the lack of immigration, and the significant structural reforms which he's found very difficult to push through. Japanese workers tend to stay at the same company for years and years and years. Very loyal, very committed, and that's good and bad. The bad habits just ripple through the company as people move up in their careers. There's not a lot of new blood coming in from outside from different companies. And the massive QQE, they called it, quantitative and quality program, will continue. There's a great big rally downgrading or rally in the yen last week when they actually talked about cutting it and did actually reduce it, but it was only a very small amount. Again, this is going to continue throughout 2018. It needs the stimulus. The economy's not growing, but it will turn around at some point. Whether it's 2018 or not, I'm still very skeptical about that. So this massive stimulus program will continue in Japan, certainly throughout 2018 and beyond, with these huge long-dated government bonds that the Bank of Japan are gobbling up as much as they can. And it's becoming more and more of an issue, and really Japan still becomes a bit of the dark horse or the black swan in the global economic world that we know key data from. Obviously, China's getting data out of China that's reliable is questioned by lots of people, but Japan remains the interesting one. Cable pound, a strong 2017, much to against as I say every week really, my bias is down for the pound, but look at that, that's proved me completely wrong. Very strong 2017. Obviously the collapse here on the left hand side of the chart here, the collapse after Brexit, all the way down to under 120 down here. Actually, I was going to put it's not. I'm going to put my clicker on. It's not, and it's rallied just like all the other key currencies. Strong rally up, and another strong week last week as we started 2018. Over 136, 37, 38 even. I'm amazed, to be honest. I think it's got way overbought, the pound, but that's a chart to tell. Is that still long here on this weekly chart? Still relatively positive. The Brexit station, lots of people are arguing now, has been the risk of it has been overplayed. Again, I'm not convinced of that still. The economy is still struggling, but wages, real wages, real earnings, as in the US and probably more so in the UK, are not keeping up with this spike we've had in inflation. Remember, inflation has got over 3%. It was over 3% again yesterday. It went to 3.1% last month. It will come down as the Brexit impact, this collapse in the pound here, drifts out of the data the guys are collecting. But oil prices keep rising. That will keep pressure on inflation. Excuse me. And this rally in the pound, I can't see it going. But having said that, lots of people that know a lot more about things than I do are talking about 140 for cable at some point during 2018. Technically, that looks very, very attainable. We're already over this 136 resistance area, 137 resistance area here. So 140 is, it's not that much of a rally back up there. But and if we do get there at 142, then we're back into this 145 area, 144, 145 area where we were pre-Brexit. For me, the trade negotiations would have to go very, very clearly. The other key risk, obviously, for the UK is the weak government there. So here we are, pivot at 33.50 or 33.60. Support stops down here at 126. So for me, that still seems a bit high. But say resistance 37, 39 and 42 basically here on this weekly chart from the pivot point of view. So fairly strong, and support down here at 126. So it's a lot higher than we would have thought this time last year, certainly. So I say the risk for me for the pound, and interestingly, this is not, this is quite key. This phrase here, UK and the GBP. It's the United Kingdom and the Great British Pound. Great Britain is just the island; it doesn't include Northern Ireland. The United Kingdom is what the government is formed on, and it's that small part of the United Kingdom, that small country called Northern Ireland, that's been the big rub for the Brexit negotiations, and also because of the border, the physical border between Northern Ireland and Ireland on the island of Ireland, and also the issue that Mrs May's very weak government is now propped up by a very small party called the Democratic Ulster Party, Ulster Unionist Party, and they have very strong views on lots of things, and so it wouldn't take a lot for those views to fall out with the main UK government, and the support could easily become unhinged. But it's always a risk. So weakened government, but it's very unlikely that anybody within her government is likely to try and unseat her. The issue becomes the call for a second referendum, though very, very remote, 10%. But the feeling or the expectations or whatever you want to call it seem to be rising within the UK. It's very, very unlikely still, but there's grumblings on both sides. Ironically, the very strong Brexiteers within the political setup in the UK, as well as the very, the Liberal Party or Liberal Democrat Party, who are still saying that they're the only party that want a second referendum, although they have very few seats. They're the only party saying that, both saying they want to do that, ironically. So both extremes of the political spectrum are saying a second referendum for different reasons. The key opposition party, led by Jeremy Corbyn, is still on the back of the Brexit. This is happening, but we want access to the single market, and that's where they differentiate quite strongly with the government. So it's a mess, and it's going to be ongoing and not going to go away. Again, as far as monetary policy is concerned, there's lots of talk about the Bank of England moving twice this year. The economy's done better than expected. Personally, I don't think they're going to act very quickly at all. And if they move more than once in 2018, I will be surprised, to be honest. But we'll see. Again, I'm wrong quite a lot of the time. I may be wrong on this one as well. But I think the outlook for the UK is much more difficult than lots of people think. The real people, out there working, their earnings are getting squeezed all the time as inflation's up. where earnings aren't going up, inflation's going up, prices are going up, and there's a huge differential between those that are getting paid very well and those that are not, and it's becoming more and more of an issue in the UK as we drift, into June will be the second anniversary of the Brexit vote, and a lot of it is all back to that. That's the key thing that's driving it. Real jobs will be, banks and companies have to plan for March 2018. By the summer, it'll only be a few months away. It'll be 6 months away from it actually happening. They've got to plan. So if they can't do business in the EU, if nothing's moved forward by then, they will be moving jobs and work-related exercises to parts of the EU where they can. So the impact is going to be quite significant. So anyway, gold and oil. We finish off, and I'll finish off with the Brexit. What time is it? 36. Okay, we've got plenty of time. So gold again has benefited from the weak dollar. Commodities have generally. The global growth benefits commodities. A big consumer of commodities, obviously, China, the world's second largest economy, and here we've had gold in a strong rally here for the last 6 or 7 weeks here. So what's this? 1, 2, 3, 4, 5, 6, 7 weeks. 6 weeks certainly up here through the key pivot here at 1282. 1320, 25 has been broken, and then we punctured over 1340, and the next resistance here very close at 1350. So last year's high at 1365 is within grabbing distance basically, and then the next resistance was from 2016. 2015 was around the 1400 level. So again, that's not that far away in that sense, and quite attainable. One would argue if this rally kept on and the dollar kept weakening. Obviously, geopolitical tensions add to the buying of the gold contracts and particularly the ETFs. Although demand slipped elsewhere, but it's had a good run. It's due for a bit of a retrace, as you can see here. 6 weeks up is a bit of an unusual one for gold. So we had a bit of a sell-off, I think, at the moment. I can't remember where we are at the moment, but strong gold, positive, bullish. End of Q1 is very important. Typically, the first certainly 2 months of the year, January and February, are very good for the gold price historically. The big Asian buyers of India and China, because of the Chinese New Year, January, February, always good for the gold price. So we've got this pivot at 1280, support at 56, 1210, and under 1200, and resistance we've already ran through, and as I said, 1400, and indeed 1600 I've seen some analysts talking about for gold, but they're the ones that want to get their names on their names in the press by saying gold's going to go to $1,600 in 2018. That's always something they journalists like to pick up, these guys with the extreme views. But anyway, so 1400 is the key resistance there. So as I said, although the gold demand, the actual jewelry, bullion, coins, it's all sort of weakening, and particularly in some parts of the world, it's very weak. But it seems to be this rush for, certainly from the jewelry and the quality gold seems to be in quite high demand. But the key area of demand is the ETFs, the exchange traded funds. There are lots of people moving into the actual ETFs rather than actually holding the commodity itself. Because obviously the actual commodity, if you had the bullion or you've got gold coins stored anywhere or jewelry, it needs to be held usually in vaults, and that costs money. So it's not a hedge in that sense against inflation, because you've got to pay those costs for holding the thing. So obviously a weak dollar means strong commodity prices, gold in particular. And any continuing geopolitical tensions would obviously aid, as I say here, commodity prices in general, but gold in particular. And that really hasn't changed, has it? Mr. Trump, or President Trump, the key issue was North Korea last year, although it was never really going to be an issue. It's the other countries that now he's perhaps turned his focus on. Iran, even Pakistan, as he's reduced aid. Palestine, he was talking about reducing aid just yesterday, wasn't he? All these tensions, all these flashpoints become an issue, and then it's the unknown issues of cybercrime and the relationship with Russia in particular, and those Eastern Bloc states as well. So gold always comes into its own in these times of tension, and as a great safe haven product. Oil, another great rally. Again, I was talking about this time last year. I thought we were going to get back up here, but the key thing for me for oil, particularly on the US oil chart here, was this level here, this 62. Let me just bring up the pen. Was this area here at $62, and we broke it. And the thing I think I was mentioning, the fact we broke it at the end of the year, we were over. That's a great line, isn't it? That's the number I was looking for. That's the key. That was the key break for me. Although on this chart it doesn't come out for me when I was looking at oil, that was a key one for me, and it's broken that, and it's broken it significantly, all in 1 week. See how it went through that all in 1 week here. I have to get rid of those pointer options. Let me go back to my arrow. Where's it gone? So 62 was key, and we're rallying up there. So here we've been up all year, basically. Well, certainly since the summer. These summer doldrums down here at 40, 42, and off we've gone. We just kept bidding. Second quarter, third quarter and fourth quarter, as usual, very strong, very good for the oil price, and that's been the case. Looks a bit overbought for me, and look at this. Look at this on this weekly chart. We're way over here. Looks way overbought, the gold price up here. So I expect it to come back and test this 62 level certainly sooner rather than later, to be honest. And the $60 needs to hold. But if $60 hold and 62 held as it did over at the end of the year, 64 and even $76 is the next stop. Because as we came down, just like we had the other chart, I can't remember what chart we were talking about, the dollar index chart, USD index chart, came down very quickly and steadily. The oil price collapsed very quickly during 2014 in particular. So as it came down very quickly, there's no resistance to it going back up very quickly, and that's the technicians would tell you. So this $68 and $76 and $78 levels are technical levels. This price could have a go at during this time next year, basically within 12 months. So at the end of fourth quarter, we could be touching $76 and trading over 70. The issue is if we, hold over $70 for the US for US oil. Remember, Brent is already over that $70 level, so 76, 78 is I see as it being attainable, although as you can see here we're quite significantly overbought. So I just want my point back. There we go. Oh no. Oh, anyway, laser points this. So very bullish. Pivot now at 56.50, support 52.5, 45 and 41, that low we had earlier last year. 64, 68 and 78 are the key resistance levels for oil, so oil remains bullish. Very key to the obviously world economy. The price is underpinned significantly obviously by this OPEC deal and the extension of the OPEC deal that we've had. But the other key thing that quite often doesn't get talked about is the Chinese are big oil producers themselves as well, and they've got this huge 5-year program that they're into the second, third year of it now, where they're investing very heavily in their own shale oil production. So every year, every time we see the oil price ticking up, we see the US oil rig count going up on a Friday in the US. Don't underestimate the impact of the Chinese shale production as well. Obviously, the two other major significant players, obviously the Russian production out of the Arctic and outside of the OPEC, and the OPEC, and the key player with the OPEC is obviously clearly Saudi Arabia, who manages the view of the whole of the OPEC bloc quite significantly. So it's always good for the oil price of the world economy is growing, which seems to be a very steady growth this year. And it's, oil, don't forget, is involved in all sorts of different things, from pharmaceuticals to petrochemicals to plastics to all sorts of things. Oil is a key asset for that. But the key thing, obviously, with the impact, the environmental impact, fossil fuels are becoming increasingly persona non grata, regardless of what the current president might think. The long-term view, oil demand and its derivatives is certainly in decline. We're looking at not just like electric cars, electric vehicles, but all sorts of other things that oil is the base for currently. There are other processes working on that. So in the longer term, there's a certain decline, but obviously as far as we're concerned here for this next year, oil still looks very well bid for me as the world's economy grows. And finally, or not finally, but in this section, finally, what time is it? 1:45. The elusive cryptocurrencies. Here is one of the craziest charts I've seen in many, many years. Bitcoin got close to 20,000, 19,000 on the 18th of December. Everybody has an opinion about Bitcoin, and that's one of the things that is good, but also frightens me. Everybody is talking about it. It's on all the news items, and when finance becomes the main headline in the main news of the night or the day, that's usually the time to be either buying or selling, depending what the highlight is. But the relentless rise, or the meteoric rise, has continued throughout the year. This time last year we were trickling around $1,000, and we've got as high as $19,300 for one Bitcoin. Call me crazy, but that just seems crazy to me in any time. And just history tells us parabolic charts like this always end up creating a nice steady V top, so the end could be quite nasty. However, on the positive side the technology that undermines this is Bitcoin, but the technology that undermines lots of the cryptocurrencies, the blockchain, is fundamental. It's taken out a lot of process, it's taken out a lot of politics, control, which lots of people don't want anymore. But the risk is key risks surrounding the cryptocurrencies are the regulation issues, because they won't go away, and obviously the cyber security issues as well, and this issue of you don't know how much of this is fraud, how much of this is money laundering, and that's going to be the big issues for all the authorities around the world. And there's some key stats, just not around Bitcoin but also around all the other currencies. So here, technically bullish, very overbought. So pivot support here at 14.3. Next support was 9.775. Support down here at 4.3, and then all the way down here. So this key gap here on this weekly chart will need to be filled at some point, and we've come quite close to it, I think, haven't we? Since this chart was put together, I think we've been down under 11, haven't we, in the last few days. So the V top is forming, or has formed, but there's some key benefits to the cryptos as well. Okay, obviously next 20 and then 30,000. There's all sorts of numbers predicted for 2018. I saw 88,000 on one of the financial websites the other day, hundreds of thousands, and again, people are just pulling out these numbers because if it moves as much as it moved in 2017, it'll be hundreds of thousands, $100,000 plus, but that won't happen. I can say that fairly certainly. So, breakthrough year last year. Although the future looks uncertain, as with anything new, it's opportunities and risks. Obviously, the early adopters, the guys that are going, when I'm talking about years ago or even this time last year, major beneficiaries. It's when they trade in, when they cash in. Do they hold or hold, as the cryptos call it? Who knows? But as a trading asset, this last paragraph here, I think is key for me. This is what this is my thoughts here. It's new and unique, but it's also rather traditional. It's new in the fact that it's a completely new asset class, and that's what excites me about it. It's got no real correlation with any other asset, and it's not really driven by fundamental news. There was a thought process, or appears to be some sort of correlation between the gold price and Bitcoin, but again, I think that was just more coincidence than actual correlation. That the big investors in gold are not going to roll out of gold and roll into Bitcoin, and vice versa, really, as Bitcoin unwinds or cryptocurrencies unwind. So it is a new asset class. It has no correlation, and it's not driven by news. It's got its own fundamentals. but it's also very, very traditional in the fact that it's driven by fear and greed and emotions, and we've seen that in the last few days, and we saw that in December when it rallied to this near 20,000 before it lost 44%, didn't it, or something in the week before Christmas. So 2018, my view, will see perhaps a lower volatility and a slower price rise. Indeed, or third option could be a complete collapse in the price, and these bubble theorists that have been on about it will be proven correct. But that happens in 2018 or not, I don't know. But history tells us that, as I say, any chart with a meteoric rise like this needs to correct, and although this is a near 40% correction here from here to here, we still need to be back down here. So there's some technical levels now starting to emerge for this the cryptocurrencies and Bitcoin in particular, that are now becoming quite significant. So this for me, this level here, 9274 or 9275, is quite fundamental technically for me, and this gap here on this weekly chart certainly needs to be filled, so we could easily get us back down to the sub 8,000 level. But even so, keep it all in perspective, 8,000 is still an awful lot of a return from when you were down here at 1,000 or 2,000 or 4,000. Percentage wise, you've had a phenomenal return, but an 18,000% return in any asset in 1 year is crazy. And believe me, I've seen it before. I've benefited from it before myself in 1999. I haven't got time to tell you the story today, but and that was a 7,000% rise in a particular share, and everybody said that was crazy, and it was crazy. And lo and behold, it collapsed thereafter. And Bitcoin or the cryptocurrencies technically have been not like nothing else before. Even the famous tulip, the Dutch tulip bulb explosion in 1657 wasn't as meteoric as this Bitcoin price rise has been through 2017. So buyer beware, and it's your money. Trade carefully, and always trade with stuff you can afford to lose. But lots of positives for it. Just to touch on, I haven't done any charts for the commodity currencies, but basically the Aussie and the New Zealand dollar did well in 2017. Both obviously very exposed to the Chinese market. It didn't have a hard landing as many were talking about in 2016. It had quite a strong 2017, the Chinese market. We're expecting 6.8% GDP growth for the final quarter of 2017. So it's a strong Chinese current market, so it has a big influence on the Aussie dollar. Remember, the Aussie dollar is a key proxy for the strength of the Chinese economy. The New Zealand dollar is less exposed to China, but it's a soft commodity producer, so any slowdown in China would be impacted on the hard commodities, the iron ore, steel production. Iron ore is Australia's biggest export, so iron ore, gold, copper, those key exports out of Australia that are gobbled up by China will be impacted first. The milk powder, the agricultural products that New Zealand produces, less of an impact. They have 18% of their exports. 38% of Australian exports go to China. So key for both these countries. Obviously, New Zealand has a very high interest rate at the moment. It may come down. Australia, again, unlikely to move this year, but again, we could see moves in both these Antipodean dollars this year as well. Issues with Australia is the overheating housing market, low and stagnant inflation. Earnings are okay in Australia. Issues in New Zealand has been the new government, which has swung to the left against counter trends in the rest of the world. But ironically, the new left-wing government in New Zealand is supported by a very nationalist, fundamentalist again. So it's a very strange mix there. Technically, there was worry over the New Zealand dollar because the New Zealand central bank was under pressure with the new government. That's sort of gone away. So New Zealand dollar is looking okay as well, and it's a key currency simply because the interest rate is the highest in the main key currencies that we look at. Canada, it's had a really good 2017, much more diverse economy than many people think. Lots of obsessed with this idea that it's only oil in Canada. No, very strong finance sector economy in Canada as well, quite diverse. House inflation, as in Australia, is a key issue. very of worry for the Bank of Canada. But it's a very jobs have sprung up in the last quarter for the Canadian economy. The Bank of Canada very likely to move later on today, first mover of 2018. The rising oil price helps, obviously, the Canadian dollar. My question remains about the sustainability of the oil price, but as you saw, technically it's going up. And then, obviously, the other key thing is its relationships with its big southern neighbour, the United States, and the continuing NAFTA agreement. But again, I still see CAD as probably the best performing of the three commodity currencies during 2018, but time will tell. That's just my views. I don't dare to trade Bitcoin stick movement, so I like the Euro, USD, and pound and yen. Okay, Magnus, absolutely. It's horses for courses. I couldn't talk about 2017 without talking about an asset that had risen 18,000%. It just wouldn't be, and it's affecting millions of people around, if not billions of people around. The other key thing about Bitcoin I mentioned about is that most of the trades are done in dollars. Most of the exchanges are in China. Japan's a big currency. The Korean won is a big currency. And my view of Bitcoin, actually, what's that gone about? The view of Bitcoin going forward again is any movement out of Japan, China, or South Korea will be absolutely fundamental to the future of the cryptocurrencies. Obviously, the Europeans and the Americans significant as well, but there's so much volume coming out of Asia for Bitcoins or cryptocurrencies in general. That's where the key changes are going to have to happen. And the big collapse we've had, I suppose, collapse is a fair word, in the last few days on the cryptos has been that the move out of South Korea saying they're going to ban it altogether. The Chinese talking about tightening up regulation again. So I think this whole regulation issue is going to continue. The security issue isn't going to go away. There's more every day. There's stories of bitcoins being stolen. There's a guy kidnapped for $1 million Bitcoin dollars for 3 days. And a Russian guy in Kiev was kidnapped for a day and a half, and a ransom of $1 million bitcoins was $1 million worth of bitcoins were given to get for him. Obviously, that's going to be a lot less than it was when they were paid him before Christmas. But you see my point. It's it's volatile. It's at the bleeding edge of technology. It's the bleeding edge of finance as well. But obviously on the positive side is it's becoming more and more of a central asset, given that the futures contracts are now open. The CME, the CBO, Nasdaq are looking to open a futures contract. The Deutsche Börse are talking about opening a futures contract as well. Many countries are using it as a way of Zimbabwe and Venezuela were talking about cryptocurrencies or crypto bolivars, as the Venezuelans would call it, to get out of the completely devalued currency. But other countries are as well. There's even talk of the UK perhaps having to look at a cryptocurrency. But anyway, whether all that happens in 2018 or not, I don't know. But certainly it's not going to go away. The technology behind it is fundamental, and there'll be winners and losers as with any new technology. So thank you. I don't know if there's any questions out there. David wrote, financial markets now trade around the US dollar since in change in the 70s from gold, I believe. Do you see any change in this over the coming years? No, David, I don't. You're right. FX market was created by Mr. Dixon, President Nixon, in 1972. I can't remember. I think it was April 1972, where they took the dollar off the gold standard. And it let it float. So until then, currencies were priced against the gold. So that's why gold was such a key thing. And now 50 years later, that is 75, is that right? 40 years later, it's a very open market now, and we can all trade currencies on very, very small lot sizes, which you couldn't back then at all. It was only the big banks, and even then it was the big banks. It was only the the NatWests and the Citibanks and the JP Morgans of the world and Goldman Sachs that could trade currencies. Now even you and I can do it. So there you go. Richard, what's your say on silver? Well, silver is very similar to gold, but let's just bring the gold chart back up. But different. I say this all the time. It tends to track. I might bring one in. Actually, let's bring the let's actually bring the silver chart in if I can. Why can't I? Because it's there. Let's just bring. So let's Let me just find it. New chart. Let me do that as you've asked. What time is it? Yeah, it's just time's up. But let's bring up the silver chart and let's just do the same template as those other ones you've been looking at. So template is Outlook 21. So here it tracks very. Actually, just let me fill that up. Hopefully you can see that. It tracks. Actually, let's zoom out a bit. So we've actually let's zoom in a bit. So it tracks very clearly, or quite often, the gold price, silver, but it's different. Silver is different in the sense that it's not only is it a precious metal, but it's also an industrial metal. So it has demand that gold doesn't have. Although gold obviously is used in industry, it's used in electronics and what have you. Silver has a much higher demand than gold. There's more of it in the world, so therefore obviously the price of it is much less. It's less the supply of it is much more open than gold. Gold is controlled by a few key miners, silver less so, but it does tend to track. So here we see bullish in the last 1, 2, 3, 4, 5 weeks, unlike the 6 weeks we had on gold. Let me just bring up gold. So there we go. You can see how it tracks down and then back up. Gold, similar sort of thing, but a bit more exaggerated. So, and they tend to track one another, but don't assume just because one's gone up, the other's gone up. That's my only comment on gold. But silver, as with gold, will benefit from any weakness in zoom in a bit, in the oil, in the dollar price, obviously. But here, technically, as you can see here on the weekly chart, it's breaking out of that downtrend quite nicely. Bounced, it came back, and it's back out of there. So weekly, certainly, it's looking very bullish here. We're over the 20 period, so but again, we've been more or less sideways for a lot of the year, since about September, autumn, winter, sideways, but big dip down, but it's recovered. So that's quite an interesting one there. You see that double, triple bottom there here on the weekly chart. 1, 2, 3, and off we go. So looking to break up basically silver charts. I hope that answered your question. Please, the second support of Euro USD. Let's have a look. Let's get rid of that. Euro USD was. This was just. I mean, everybody, you can do. Simone, you can do this. These are simply the pivot, the monthly pivot points from your MT4 chart. So everybody. Oops. What were we talking about? Euro US4, wasn't it? So support 16.95, 13.88 and 12.24. So that one you're after 13.88, so call it just under 14. So if we go up to the chart, second support is down here because of this roll up, roll down, but it's the halfway basically of this rally up we had during the spring and early summer for euro dollar, the Macron effect as we call it. So 13.88, call it 1400 for a round number. Okay, hope that answers your question, Simona. But again, this looks at 110, but 112. This is now saying 112.24. So the ripple effect has dragged the support up from this low zone we hear. Remember, beginning of this time last year, people were talking about 105 and euro dollar going to parity, going to 100. So a year can change a lot of things, and here we are at punching up to 123 or over 123, and 130 being talked of as a possible target for 2018 over the next 12 months. Okay, so I hope that was helpful. Long-term views always, it's a bit of a stick in the air, but let's go. Richard, has the Forex video? Yes, the competition, the end of the year. Yes, the viewer. I think it's been up on the website. It's certainly been up on the Facebook website. There was 10 winners. They were all being obviously contacted now. But have a look on the Richard. I'll send you an email to the link of it if you want to see the link there as well. Okay, so there you go. Thank you very much, everybody. Tomorrow is let me just click through. Tomorrow's webinar is. Otto from Blue Sky talking about Celt nut channels, another variance on channels and volatility measurements. Obviously, Tuesday is every Tuesday is live analysis. Andrew's talking about the Premium Trader Tools Part 2 next Wednesday, the 24th. Great little package that, those Premium Trader Tools. Very, very simple, like the ones we had on the charts out there with the pivot points from the Trader Tools. And then Fractals and the RSI Fractals on Thursday. Hang on, 23rd. No, next week, Fractals. And Fractals at the end of the month as well. Okay. Hopefully we'll have next month's webinars up soon as well. So again, contact us if you want a particular topic to be covered, whether it's price action, a particular indicator, some fundamental things that confuse you. Please put them on either on the Facebook or email us. Actually on this slide, but email us at webinars@forex.com, and we'll endeavour to add your topic to our list for February. Okay, so thank you for your time. If there's no more questions, I'll call it a day and go and get some lunch. Any final questions, anybody? Oops. One, two, three, four, five. Quick countdown. No. Okay, great. Thanks for your time, everybody, and I will see you again next week. Okay, take care. Thank you, Magnus.